She can hear it, yeah.
Ladies and gentlemen, part two. Can you please come and sit down? Like the 10 minutes are over. Ladies and gentlemen, please, can you come and sit down?
So you go first.
So, ladies and gentlemen, I would like to introduce you to our chapter lead, Matthias Hausherr. So he came from the US to us. So he's also the president of the Southern California Swiss American Chamber of Commerce. So a warm welcome to Matthias. A bit more louder. Okay, floor is yours.
Thanks, Marc-Andre. So hi guys, thanks for staying and not leaving for the second part. So I appreciate the stamina. Matt Hausherr. I'm, as he said, the president of Samba in the US. And it's great to hear from all you guys from the panel before that we are actually doing awesome. So my 401k is safe, all of my dollars investments and everything is fine. So I actually can go home, right? No. Okay, now I'm going to stay here because we're going to talk about private markets. And I learned that last year you already tapped into this field. And I think it was quite entertaining. So we thought we're going to do it again. So I'm starting with a question. Who owns a company, a startup, is an entrepreneur in this room? Holy moly, much more than I expected. So who of you is in growth stage? Okay, okay. Love it. So what do you guys need the most? Money, exactly. Money makes the world go round. So what put me to America is actually raising money for Swiss entrepreneurs. So my company, Transatlantic Partners Group, is a boutique advisory firm. We help growth stage Swiss and soon also European companies to land and expand in the greatest country of the world, the United States of America. So don't laugh, don't laugh. I mean, you heard, it's great, right? I'm not kidding you. I'm not making that up. So in the next 45, 50 minutes, we look at financing a little bit more from an entrepreneurial side, right? What does it need? What is actually required, and what brings success if private market companies, right, are seeking for capital, and how does capital find them, for what reason, and what are good ways to do it and what not so much. So having said that, I also changed a little bit the program for tonight. So what I actually want to do is to give you a little bit of an insight into certain business models that actually drive different business strategies within the private market. So I'm actually very pleased to have directly from Jakarta, Singapore, Washington, D.C., all over the world, Kai Schmidt from Crestone VC, to talk a little bit from a GP side. What does it mean to be a venture capital investor in emerging market finance and technology companies? Kai, stage is yours.
Thank you, Matthias. Yeah, so we have to change the topic here quite a bit from what we heard before. Very large public equity bonds and so on. We have a very, very niche strategy. We have started a firm 2 years ago to look at one very specific sector, which is financial services and technology in emerging markets, high growth emerging markets. Because my partner and I spent the last 15 years as founders and investors in emerging markets. He started a very large marketplace in Southeast Asia, actually the largest e-commerce marketplace in Southeast Asia. And I spent 10 years or so investing for the IFC, the Investment Bank of the World Bank, in financial technology in emerging markets. What we realized is that in high growth emerging markets, there's typically a high degree of urbanization, and in the urban areas, there's a high degree of use of technology, and the people are very digitized. So what you find is that you have 600-700 million people who are middle income, typically young and typically highly digitized, who have very, very limited use of financial services. So if they have a bank account, they deposit their salary there, but they don't use it for anything else. And you go from there and you go deeper into financial services. You look at capital markets, you look at any other sector, payment systems, and so on. You see the same pictures, right? So after doing this for 15 years for other people, we decided we wanted to start our own firm and really focus on this opportunity. And obviously, when you do this, it's initially shocking, right? Because you have venture capital, which is very risky. You have emerging markets, which is also very risky. And you have FX risk, and you have all these risks. And in the end, you think, okay, can we really execute this strategy where we are doubling down on risk, and are the returns really that good? And is the growth opportunity really that different to financial services and fintech in the United States, right? There's still a lot of fintech that is very successful in the United States. So does it make sense to be in emerging markets? And after we analyzed this for a pretty long time, we decided that, yes, it is actually still a very good opportunity. And many of the risks that you typically see in emerging markets, I would say in particular currency devaluation, is actually made up for by the higher growth rate that you get because of the lack of competition, right? So if you think about banking services, for example, and consumers, the numbers that I gave you, 600-700 million people in Southeast Asia and Latin America, certainly make up for or make it for a much larger growth opportunity than you find in the United States, where everybody is already banked and everybody already has 4, 5, 6 credit cards, which are typically maxed out. You don't have that in emerging markets, right? People don't have credit cards, they don't have access to lending, and hence you have a very big opportunity. So when we started to dig deeper into this opportunity, we also thought about, okay, well, this is a very large market. So we are a global emerging markets fund. There's a lot of countries that we can invest in. But we realized that the business model in the high growth markets like Indonesia, Brazil, and so on, are actually quite similar. So if you look at a payment infrastructure company in Brazil and one in Indonesia, they typically are quite comparable, right? So we decided, okay, we can call ourselves a global firm, but we will never be able to invest globally. We will need to find markets that have similar business models and where we can generate synergies, right? So we ultimately decided that those markets are probably the markets outside of China and India, because those are very, very specialized, very different challenges, a lot of specialized investors. Whilst in Latin America and Southeast Asia in particular, you don't have so many investors. You don't have one large market that is completely dominant. And we decided to look at that opportunity. To give you an example, in Brazil, for example, if you look at Sao Paulo and Rio de Janeiro, you have about 30 million middle-income consumers who are mostly underbanked and middle income and very digitized because they all live in urban areas, right? So you have a GDP that you tap into that's probably larger than the GDP of Belgium, for example. And you see the same in other markets. China is an extreme example of this. There's many, many cities in China that are fast growing that nobody in the West has ever really heard about, that have 10, 20, 30 million people. But you do find the same in Southeast Asia and in Latin America because the urbanization is so much larger. So you have a lot of young people that typically all are using Facebook and WhatsApp and using digital services. They all buy online, they all use marketplaces, but the usage of financial services is very, very limited, right? That's the opportunity that we decided we wanted to tap into, being well aware that this is very, very specific and very risky. We started the firm about 2 years ago. We started to invest a year ago. At the moment, our largest concentration is probably in financial infrastructure, both on consumer and business side. So we like a lot payment system, payment infrastructure, capital markets. We've done quite a bit because if you think there's very limited provision of banking services, it's even more pronounced in anything related to debt and lending, both on the consumer and the business side. And to change that, you need infrastructure, right? You need credit bureaus, you need infrastructure to operate loan portfolios, you need risk underwriting technology, and so on. So we are very heavily invested in those areas, which are effectively the roads that you need to build first so you can provide financial services to the segment. We right now operate two different strategies. One is a traditional venture capital fund that invests very early, typically I would say seed and A rounds. And then we have a mandate with a large European insurer where we invest what we call early growth, so typically B and C rounds. I guess most people are familiar with what that means, right? I'd say tickets $3 to $6, maybe $10 million, and companies that typically have $5 to $10 million in revenue are cash generative, or at least very close to being cash generative. And for this European insurer, we have a commercial mandate, so they're an insurance company, right? They want to generate returns. But because we operate in emerging markets and because we facilitate services for underserved people, we also provide impact reporting to our clients. So we don't do this for the early stage fund, but we could. But certainly in the growth stage fund, the companies that we typically invest in very quickly serve tens of thousands of small businesses, or in cases, hundreds of thousands, sometimes millions of consumers with financial services to a lot of people that haven't used them before. So there's a huge financial inclusion opportunity. So we report on impact metrics as well. In terms of returns, we obviously target venture capital style returns, even on the early growth stage mandate. And as I said, we need to outgrow the currency devaluation that you typically see. So I would say in terms of base returns, we're looking to anything between 25 and 40% IRR. still in early stage. We are at early stage ourselves, but so far from what we see in our portfolio, we think we can make those numbers, and we do feel that the opportunity in emerging markets outweighs the opportunity that you still see in Europe and in the United States. Thank you.
Thank you very much, Kai. And we will talk later a little bit more about opportunities in VC and private equity markets. But I want to touch into something that was said before, right, about opportunities for Swiss companies in the US. So for the Fortune 1000, the Fortune 2000 companies, right, there is a caveat to actually just expand and raise capital and actually do more. It's pretty easy, pretty straightforward. But all those growth stage SMEs, right, or startup companies, they have a much harder way, right, to raise the growth capital in Switzerland for a model that hasn't been proven yet in the market. And maybe now with some tariffs coming up for certain investment or product or classes, it might be even a little bit more of strategic importance to build up larger operations over there and just distribution and marketing. So we expect in the US really high growth of incoming Swiss, especially tech firms than we have seen in the past, because Europe and other markets are, as we also heard before, are doing not as good or expected doing not as good as the United States. So it's now the time for Swiss firms that have a scalable business model to go into the US. And I'm very pleased to have Robert with us today, who actually invented and built a business model that actually, how would you say, navigate the capital to those, you know, let's see, a little bit undisclosed private companies to actually get that growth capital right away. So please give a warm applause to Robert and introduce Unicorn Anchor. Oh, you need your presentation, yeah. Can somebody help Robert with the presentation? Mr. President himself. Wow.
Thank you, Matt, for the perfect presentation. So I'm happy to tell you today a little bit more about Unicorn Anchor and what's the magic of our approach. Most likely you never heard that before, what I'm going to tell you. So I'm not going to tell you what's on the slides, but maybe what's the magic behind the slides. What does it mean, Unicorn Anchor? We want to set the anchor in building unicorns from zero to hero, really when it comes through the whole value chain of the game. So we not focus on an early stage or growth stage or exit stage. We try to cover the full journey with our different services. To explain you what we built, I maybe tell you a little bit more about myself, because I learned by pitching that hundreds of times to family offices or to investors, it's easier for them to understand what I built. So my life over the last 34 years was to be a private banker, taking care of entrepreneurs and their successful succession planning in a family-owned company. Once you do that successfully, the entrepreneur has two things, time and money, and still a wish to invest entrepreneurial. So my classic banking offering was for them always the boring part, which is necessary. But they were more interested to invest in young companies, in great ideas, in bigger visions, be part of some big solution in the world. And they always ask me, Robert, I saw on the Federal Institute of Technology a cool startup, how can I invest? Or are there more people like me which can do that? Can you help me? Then you're sitting there as a banker and saying, okay, but I try to preserve your wealth and not put you at risk. So how we can do that? I started with an approach called startup matchmaking within my last station of bank, which was Welschad & Co. private bank here in Zurich, covering the German-speaking European market. Everybody liked it in the bank, all my other RMs from other divisions. but compliance was not so happy because I did it cross-border. And I always heard, I can't do that, I can't do this, I can't do there, I cannot speak with this client, we cannot have this kind of contract. Or when I pitched them to our executive committee and said, I need money for a new IT, of course, they were also not so much amused about that. So I learned at some point, there's a big need for professional investors to invest into startups, and a big need for the startups to get access to professional investors. But most of the family office you not find on the internet. So you need someone who have these connections and contacts. That was my kickoff to say last year, bye-bye banking career, hello entrepreneurship. So that's where we started, two of us, my co-founder Ruben Welsch and myself. But it's not only us two, please go forward. It's a full team we were able to establish. We founded the company in April. We have a board, we have investors, we have entrepreneurs which trusted us, we have family offices which trusted us, we have investment bankers which trusted us, and all of them who are invested in our company or in this mission to create this smart venture ecosystem on a platform have a specific role to support us on this journey. So what do we solve in the market? When I was in my banking career, I was sponsor of an international startup roadshow going to Silicon Valley. So we took the 10 best deep tech startups, went to Silicon Valley for 1 week and pitched to several tier 1 VCs. There I learned how a mature professional approach of looking on startups should look like by checking the people and checking the tech. Coming back to Europe, I understand we look completely different on that. For most of family offices, it was in the very beginning, let's say the market in Europe starts like 10 years ago, more or less, to be established. It was for them a tryout. For some others, it was more a fun investment. For some others, it was, let's see what happens. We invest in 2 or 3 startups and we'll see what happens. But we all know here, venture capital is the highest risk asset class. And as a banker, you would think, then higher the risk, then better you should manage. So put resources and experience on it. But most of them didn't have it. On the other hand, I understood also, when the Swiss startups go to the US and pitch to professional VCs, they have always great business model, great technology, great service, super team, but no revenues. So they not understand what attracts an investor. So my mission is to solve the problem of lack of professionalism between investors, but as well the founders, by educate both of them and make a proper match and find really the best investor for the best startups. It's not to connect mass and mass, as you might find it on the internet and several other matchmaking platforms. It's combining class and class. And that's how we believe we can create unicorns. What sets us apart to really do this business? I also learned in my career that there are per stage different type of investors and different type of advice. Typically seed stage or other animals running around, so-called family, friends, and fools. Fools is not a bad term, but they need to be foolish to invest in an early stage. At growth stage, you have a lot of family offices, professional VCs, unfortunately not institutional investors, not yet. And at exit stage, when it comes to exit, you have the large investment banks, but each of them is only focusing on one specific stage. And in the transition from one to another stage, there happens always a break, because you need to understand what happens in the next stage to be prepared to raise their money. That's where I learned a lot of founders not understand the next stage, even though they're investors. So that's how we try to help. How are we integrated? We are partner and sponsor in Switzerland of this International Venture Leaders Technology Roadshow. So we have a close access to the universities such as Federal Institute of Technology or EPFL. That gives me still the magic source and access to the greatest market, as Matt said, in USA. And I learned this market is simply just much more mature. You have their investors doing this business since 50 or 60 years. Here you find most investors doing that maybe since few years, since maximum a decade to invest. So we believe clearly there is a long way to go. We are maybe in Europe, I use this term, in a kindergarten shoes. Next step of evolution will come, more services will come in, more professionals will be there, and that's what we will cover. So on what we focus at the moment, I told you we have 3 different services. Early stage will be investing in startups. But before I can invest, I first need to make my money. So we do now matchmaking at growth stage, which is Series A and B. We have a pool of some hundreds family offices and VCs investing alongside us or with us. And we target the potential unicorns. How we define a potential unicorn? We are not interested to invest into the next SME or the next local hero. We try to find out really the next disruptive global hero who can change a market. That's what we're looking for. And how we do it, I already told you, so I can make it short. We have matchmaking as a service at growth stage. We offer to the investors what is uncovered or untapped so far in Europe, a systematic secondary venture market, not only the primary market, to keep the liquidity and the turnover of the money higher. We will invest ourselves, and we cooperate with a lot of investment banks on the exit advisory path, just to make sure there can happen an exit. So we try to become a platform. Technology is the key of all of that. And when we speak about this one-stop shop solution, it's for me important. We use all newest technologies. We use also AI. But we believe that AI will help us to make better matches and not replace us. Because the connector to a family office or a VC will be always the human. Because only the human can build trust to those investors. We have a classical screening process. I will not go through, but what I want to tell you is what we want to try to find out. We want to try to find out this unicorn DNA. So what sets founders apart from others? Why do take some founders better decision than others? And not only the classical technical way. Work in progress. We work with a university in Bozen on a scientifically based approach, which never was done before, and use it in our screening situation. So last but not least, we try to build on a global one-stop shop for venture advisory services, offering primary and secondary investments, building unicorns on the globe, and hopefully become ourselves a unicorn in this specific business. That was from my side. I hope I got my 7.5 minutes.
You were awesome, man. Applause. So I don't know about if it's the greatest market in the world, but at least for Swiss companies, it's one of the largest market in the world to scale. So I don't know if you guys know, by now, the USA is the largest export partner as a country, right? Larger than Germany, larger than everything else. But also do you think is Switzerland a small, a medium, or a large player in the US when it comes to foreign direct investment? Who has an opinion? How large? Exactly. So Switzerland is the 7th largest foreign direct investor in the United States. So behind, Japan and China and probably the United Kingdoms and Germany, Switzerland comes very, very quickly, right? In front of Spain and France and Italy and everybody else that are big players in Europe. So Swiss companies are granted respect. If Swiss entrepreneurs come over there, people are listening. And you know why? Because Switzerland is known for paying well, keeping their promises, and paying on time. And that's why US partners, and I can talk, I've been living there now for over a decade. In Southern California, Switzerland is number 5 in the markets. And those partners there, companies, investors, universities, state agencies, they love to do business with us. So if you have a business you want to scale in the US, please reach out afterwards, come to me, go to Robert. He actually can do where to get the money, can tell you where to get the money from. So where to get the money from, we are always asking for people for money, But now we have people actually here that I want to introduce on stage that give us money. So warm applause for Bertrand Dor. He's the Chief Investor Officer for private markets, private assets of Schroders, and Roger Studer, CEO and founder of Studer Family Offices. And then please, gentlemen, back on stage for giving a little bit more insight what's happening in private markets nowadays. So I want to quickly give you a couple minutes, not a couple minutes, but a minute for a quick introduction. Bertrand, you want to go first? Is it not working? Take this one.
Is this better now? Okay. So my name is Bertrand Dor. I'm working at Schroders Wealth Management in Switzerland. I lead investments in private assets. So that includes, private equity, private credit, and other asset classes. Schroders has, a large presence in Switzerland with more than 400 employees. And actually, it's probably one of the Swiss banks which has started investing in private equity the earliest in the year 2000. So it's really a long experience. And so we have executed a few hundred investments in funds and in direct investments for our clients.
Thanks, Bertrand. Roger, do you want to go next? Quick intro.
Yeah, sure. Welcome from my side as well. Thank you for having me here. So I was a banker actually for 30 years. And we did all that private equity, listed equity, private debt, investment banking. I was heading in the end an investment bank. Some of former colleagues are here. And then 2019, I decided to quit banking. Not because I didn't like it, but because I had so many ideas which I could leverage on my own as an entrepreneur. And then I thought 2019, okay, I quit banking, but not finance, because that's what I understand, finance and technology. I mean, being a banker means you have to know data, technology, software. That's actually compulsory. I think that you can run the business, especially if you run an investment bank as I did. And we had there quite maybe 2 dozens of digital ecosystems, which we deployed with all different clients and different value chains. So then I decided 2020 to set up my own family office, where we have actually 3 main pillars. It's the private market side, where we include real estate, project development, and within private markets, we have private debt and private equity. And then we have the asset management part. Maybe to be a banker, and the guys who know me, I'm very much in favor of passive asset management, because I was 35 years in the industry, and I really like if there are blue chips or listed stocks. For me, there is not a lot of value actually to analyze that. But you never know. If a lot of people stop analyzing blue chips, then it might be worse to analyze blue chips. And on the ETF side, that's the asset management, maybe 80–90% of the AUMs. Then we have 5 to whatever, 15–20% in private markets and private real estate. And yeah, that's what we do.
Awesome, thank you, Roger. So, and I think later on we're going to tap into data analytics and AI and what does it mean for the private markets and the alts industry in general. So thanks for that. So I want to actually quickly ask about what's the temperature in private markets right now. I know the last 2 years were a little bit, sneaky or dry. So I want to start with you, Bertrand. How do you feel at the moment? What's going on?
I think the answer is pretty good. If you look at the long-term growth, at the beginning of the century, investment in private equity, for example, represented $1 trillion. Now it's $7 trillion. So quite an impressive growth. Okay, the last 2 years may have been a bit more difficult, but still there is quite a lot of growth in the markets. When you look at assets raised, for example, the large cap buyouts, it's quite impressive. So still a lot of things to come. And same, I think, for private credit, for example, direct lending was very small before COVID, and now it has become a significant asset class. So we see that there is still quite a lot of growth. And if I may add to that, also historically, a lot of the investors were the large institutions, the large LPs, and now we've been able through structuring to offer those investments also to smaller investors, even to retail investors, and also obviously the regulation has helped quite a lot. But through the structuring of funds, the so-called evergreen funds, now you can reach quite a lot of clients, which means that basically the ecosystem is growing.
All right, thanks for that. Kai, how does it, okay, from a fundraiser and GP point of view, how does it look like?
It's been indeed very difficult. The big upside is obviously that asset prices have completely reset, right? In our market and technology, multiples of whatever you want to use as an evaluation metric were insanely high in 22, and they really fell off a cliff. Even our markets, even in emerging markets, things were very expensive, especially in the larger markets like Brazil and Indo. Fundraising was very difficult, still difficult, but I think it's beginning to get better. And the timing is probably good, right? I mean, it was hard to raise money, but it's a much better time to put money into tech startups, I think, right now. And I think we're probably at the beginning of a new cycle for valuations to increase. So right now they're pretty flat. I mean, you get 3-4 times revenue multiples on companies that double or triple revenues a year. So I think that's quite attractive now.
Roger?
Yeah, I mean, it's twofold. On the private debt side, actually, we have great opportunities. There is somehow a credit crunch, especially for project development and some residentials due to new regulations coming here in Switzerland. And we have our main focus in private debt here in Switzerland. So a tremendous credit spread widening actually for good collateral in terms of real estate or project development on the private debt side. On the what we focus on the private equity side is reasonable multiples in terms of business models where we think we can scale. So we pay maybe in Switzerland 5 to 7 multiples for that company is what we want to invest. We have patience. We don't have pressure from a fund to invest, so we can really wait as soon as we have possibilities, we're gonna invest. And our strategy is in certain areas in tech and in software development that we buy and build. So normally we identify a platform where we think it's scalable in terms that we have managers and an overhead which is capable of digesting new inorganic growth and buy opportunities. And what we see now is actually for us, it's a good time now. We have a lot of generation changes. We have the credits on the private equity side. There is appetite to invest. It's not the same. Normally banks are not in the business. That's the beauty. We are in a sweet spot of EV. We start EV 5 million up to 20 maybe. But that's a nice spot actually for a family office like we are, a little tiny family office who has a clear strategy and a clear focus on certain industries.
You mentioned you want to chime in here, or can I?
No, of course, I can give some insights about more the puristic growth stage venture capital markets. So given today was published the report from Atomico Ventures about the state of European tech report 2024. Taking the summary of that is even 24 was a very difficult year for startups to raising money. They raised this year less than 23, which most of us thought 23 was already very tough. It was not, it is now. What we see now a turning point. So typically what drives the venture capital market and the risk on or risk off appetite of investors, it's high interest rates. When you have high interest rates in USA like you had before, on 5% risk less, why to take risk? So the investors are sitting apart and waiting. You're rewarded in 2 ways. Waiting means the founder comes more under pressure and have to come down with the valuation. So when you wait, you will pay less for the startups and put the founder more under pressure. We have today a 100% investor market. So the investor tells how he wants to invest. 3 years ago, on the peak, 21, we had a completely founder market and a negative interest rate environment. What of course also not helps in the market is any kind of unsecurity. And we have a lot of it. But in Q4, we see in our matches we do, for the first time since a long time, higher valuations are now paid for startups, interest rates are coming down, and money gets unlocked. I'll give you some 2 or 3 numbers which are very much impressive. Only in US, how much money you would guess are sitting the top VCs on the cash account? Give me a number.
Trillion?
Almost, it's 386 billion of cash are sitting the VCs, and the VCs are not paid to sit on cash. They are paid to invest the money and create a nice exit. So there's a lot of money which is waiting to be invested. And same we see on the family offices in Europe. A lot of them were waiting, had their fuck-ups in the last 3 years, didn't have their exits, are liquid. Sorry, these are the venture capital terms I use. That's the reality. So there's a lot of money waiting to be invested. And we feel that's just the beginning of a next upcycle, which might come up in the next years.
So I see Kai smiling right from both ears. Yeah, a lot of nice things coming along. So you mentioned private debt before, right? Do you see certain, let's say, trends in terms of new products on the private debt side coming into the market?
I love this private debt business actually, because this is really evolving now, and especially in Switzerland with this FINMA Finnish Basel III. There are a lot of opportunities in the private debt market. And what we see now is the wrapping of certain private debt strategies, so cooperations with crowdfunding and issuers of ETPs, products, also exchange traded products, so that even, let's say, not only the qualified investor, but also for these particular, I would say, simple products, even the retail investor would have access or has access to a private debt backed with mortgages, and the yields for the risk, what you have there, it's tremendous. What you can have here in Switzerland, and there you don't have any currency risk. You end up maybe 5 to 6% on the private debt side for first mortgage. That's where the market is now. And beside that real estate project financing, it's a very interesting business. The banks, they stopped, or some of the banks, they had to stop. And some of the real estate developers, they really pray for liquidity. There is a credit crunch, I would say, just coming by the end of the year and beginning of next year for all these developers who bought a lot of real estate plots. They have now maybe some projects which they would like to sell, and to sell to end clients, it's not that easy as it used to be for that high prices. So yeah, your question was private debt. I guess private debt is very interesting now. Yeah. You
touched on real estate, right? Real asset market. Where, I mean, Switzerland, Europe, the US, where do you see there the most opportunity, especially now? For example, in the US, right, housing crisis, not enough land to build. I mean, California is imploding, right? So maybe for you, Bertrand, right?
So in real estate, we do a little bit more in Switzerland actually, and where we see the biggest opportunities is really in the brown to green transformation. So basically all the sectors more or less must be carbon neutral in 2050. And you see that the institutional investors, they want to help with that. They have adapted to these regulatory requirements, and they want to make investments which match those trends. And actually a lot of, of what they buy now are the typical good green assets. But if you have an asset where a lot of work needs to be done, a value-add asset where you need to improve a lot of the characteristics with heavy work, a lot of the institutions don't really want to do it at the moment. So for us at the private bank, we see an opportunity to sell this type of projects to the retailer or to the elective professional clients.
Anything to add on that?
Yeah, I think there's actually an interesting combination between the private equity market, private debt market, and real estate, especially in emerging markets, because in most emerging markets, there's very limited supply with mortgages, for example. So in Brazil, which is a market that mostly grows vertically, right? Everybody lives in condos, lots of condos. There's a stock of several $1 million of fully paid houses because people effectively pay their houses in cash. And if you want to get a mortgage, you get a mortgage for 5 years and you have to put down 40%. So very different to what we have in the US. We had a few years ago. There's no technology startups that partner with private debt companies. So the technology companies originate mortgages, which the banks are unwilling to do, and sell them to the public, to the private debt market, like through structured vehicles. One of the most famous Brazilian tech companies, which is probably going to IPO in a few years, is specialized in mortgages and home equity loans. Sells all the assets to private debt companies.
You were touching on valuation, right? And in private equity or also VC, right? Valuation of potential targets is always a very interesting topic, right? Risk and the value. So how does the advent of AI and this kind of tremendous amount of data that can be compiled through algorithms impact your business in terms of better understanding where to tap in and where not? Maybe Robert, you can go here.
Yeah, it taps us significantly because we have a lot of data from investors, and we have a lot of information data from the founders which want to grow. So AI will help us clearly to make in the future better matches because it's a big data game. Then better qualified data you have, then better the data understand how to find each other, then better would be our quality in matchmaking. And we strongly believe when we are able in the future to put the perfect investor together with the perfect founder, and both have the same understanding of what should happen with the money, management of expectations, then growth can happen. So AI will have an impact, but never replace the human. That's our belief.
Bertrand, I know you have at Schroders, you actually have an answer to that, right?
Yes, absolutely, we do. So I will talk about what is done at Schroders in private equity with regards to the use of data and AI for especially investment screening. So Schroders has invested in 7,000 portfolio companies, either directly or on a look-through basis. So we have a lot of data on a lot of companies. And so a model has been developed where you can basically use prompts to ask questions to the data rooms to which you want to analyze. And then you have, say, the model which can build a big portion of the preliminary investment memos for the committees. So which means that the analysts who is looking at different companies can first have, say, a first few thoughts on companies very quickly, so they can screen a very large universe. And then when they go to the committee, they can really focus on the task where there is a more value added than simply answering the simple questions. That's one model. And there is another model in which you can describe a company. So for example, the sector, the type of business, the business model, the geography, and the model will tell you which are the closest peers, which are the suppliers, and who are the potential customers. So the use of AI, I think it has just started. So far, it's not going to replace an analyst fully, but it's a great help.
How is it in emerging markets where data sets are maybe not as solid as in Europe or in the West in general?
I mean, for us operationally, we use AI to find deal flow actually. So it's obviously, as a VC fund, the biggest challenge is always that you need to get into deals early. You need to find the good deals, and typically it works through relationships, as you will know. But you can't see everything. Even if you have the most amazing relationships, there's still some founders that you don't see. And we, for example, and I know some other funds do the same, we use an AI tool to monitor, for example, what's going on LinkedIn, right? We monitor which highly educated person goes from Nubank, say a big Brazilian neobank, and starts his own company. or who is talking to certain funds, or who's talking to certain people at large Silicon Valley VC funds and so on. We then look at those companies and analyze them and see if they could be suitable portfolio companies for us. So on that, you have pretty good data. I think in the rest, obviously, I think there is AI in most companies. I think there's almost no fintech startup anymore that's not using AI in some way, but it's simply not generic. They will use some tool, and it's more analytical, but it's not. I think in Brazil, there are probably some generic AI companies that are actually very good. Our first exit was actually to a company that got sold to Nubank, and it was an AI underwriting tool. But I would say typically in the emerging market, you don't see generic AI, not so much. Other maybe China.
Well, having a heavy FA and wealth manager crowd, right, that give investment advice, I understand. So I want to actually kind of shift gears a little bit and look from a portfolio management perspective a little bit, right? And I think there is nobody better than you, Roger. So how does private equity, private debt, or hedge funds kind of enhance a portfolio strategy for an individual investor?
Yeah, we love it as well, AI on the daily work side, on the investment side. But it's really incredibly important for us on the investment side. Huh? So, I mean, it helps all screening stuff. That's great. But we have later on, then we have Createch, this one software development company, and we run through our whole portfolio. What are the business models which we have on these three layers for AI? Huh? So the production on the AI side, I mean, you can imagine on a software development company, it's incredible how you can speed up and how you can gain efficiency with your software developers in terms of AI, no code, low code. Then on the client side, each and every of your clients of each and every company has a necessity for AI advice, for AI tools, for AI software, and that's, I guess, on the investment screening side. How can you transform firms mastering the AI technology and helping them to expand client base and global reach? And for us as an investment office, where we have this 15 to 20% private debt and private equity, there is the beauty in this AI, not only on the valuation and on the search.
And maybe to answer my question, when it comes to a mixed portfolio, right, between public and private securities, how do you see at the moment your advice to your clients? How much of, let's say, private equity funds you put into a portfolio in terms of kind of jeopardizing the traditional 60-40 approach? Where does that journey go?
Sure. So basically, the simple answer is that it depends on the client wealth. So you won't recommend something, the same thing to a client who has 2 million of wealth and to a client who have 1 billion of wealth. And when we look, there are a lot of studies, right, on portfolio allocation. And maybe something which people do not have in mind is that, for example, for family offices holding 1 billion of assets, there is a 60-40 portfolio. But this is 60% in traditional assets and 40% in alternative assets. So when you look at their exposures, they typically have 15% in private equity, more than 10% in real estate, about 10% in hedge funds, and then they have some say smaller asset classes like private debt, infrastructure, sometimes arts, etc. So the new 60-40 portfolio is 60% of traditional assets, so listed equities, bonds, cash, and 40% of alternative assets.
Any other, maybe Roger, you probably have an opinion here, or Robert?
Yeah. About the allocation, that's of course the perfect allocation as is recommended by every bank, but most family offices look completely different in terms of asset allocation. There are some of them that like much more private equity, private debt. I have even a family office, they have 100% of their allocation just in venture capital. It's always a question how well you understand the asset class you join. And in venture capital is to me important. That's what I understand on professional investing. is if you put a part of your assets into venture capital, which is high risk, you need to understand that investing in venture capital means I am able to lose money. Because only when you lose money, you can win the big money. But all the statistics tell you clearly, when you make 10 investments and you are well diversified in startups, you will lose, of course, 7 to 8 times and have these 1 or 2 unicorns which will pay off everything. What I learned is it totally depends on the family office, their value proposition, how they structure the wealth. But of course, that's the basic classical how it should be.
That's the mean.
Maybe some thoughts about the topic AI. Is AI capable of outperforming an index? Huh? I guess that's the question who drives us all. And for us in our family office, we don't believe in that. We believe that the good old CAPM, it's maybe not that bad if you have all the data. And I've been in the market for a long, long time. Are there models which are capable of sustainably outperform the market? I guess there are some typical small cap effect, maybe value effect, and so on. But are there really models who are capable of outperforming the market for a long, long time? For our family office, we don't use AI to allocate the assets. Huh? Maybe in the future there will be a way. I don't know. But for the time being, I've never seen a model so far which works better than this normally portfolio efficiency theory, which we believe in.
There's just a quick fun fact about AI when we speak about that. We all of us use AI to make our life easier, but AI still works around of us. I was recently at Google HQ here in Zurich and listened to their vision of AI. Their clear vision of AI is, when I listen to the top coder of Google, to replace him and make his job that he can go back to Indonesia and have a nice life. So their idea of AI is replacing the human being and do their job, while we do the opposite. And I more believe that AI should be around the human and not the other way around. But big tech is doing the other thing.
I want to be a little bit conscious of time, and you guys are thirsty. I can see it in your eyes. So I want to just touch on one, I think, very important topic. It's about, you said you need to be ready to lose money, but it's always also, I need to have cash at one point, right? So let's talk a little bit about liquidity and how that does trend now when private market investment become more retail and become a little bit more liquid. Where does that journey go? Who wants to take that?
Maybe I can start.
Yeah, sure.
I think what we have seen is really the emergence of what we call evergreen funds or semi-liquid funds. So what are those funds? Those are open-ended funds, and basically clients can allocate money usually every month or every quarter, and usually they can redeem every quarter, which means that when you have a big fund, with a lot of different investments, which will get an exit at different point in times, and with a lot of different investors, you are kind of making the bet that overall you will be able to redeem when you want. And this is actually quite powerful. This has worked quite well. And now in private equity, you have more and more asset managers proposing these type of investments. And typically, especially with the LT4, LT2 regulations, you can show those type of investments to retail clients. So we see a lot of funds which can propose minimum investment subscriptions of 10,000, which means that retail clients can now invest easily in those type of markets like only the big institutions did before.
So I take the bet for the venture capital market. Liquidity is king if you want to invest over the full cycle of building unicorns, because you need always your exits to have new money again to invest again. What I saw in US to have liquidity is an average holding of a US venture investment is 2.8 years. Here in Europe, it's almost 9 years. So at the same time, the American invests 3 times in a venture while the money is here stuck. So we have a kind of an illiquid market, and that's what we try to build on our platform. Once we have the primary market, we give also to our investors the opportunity to sell their portfolio holdings and create a secondary market to increase significantly the liquidity in this market. And that only that fact will help massively to grow the venture capital market in Europe or in other emerging markets.
That's right down your alley, right?
Yeah, I mean, I don't doubt the data, but the average VC fund in the US still gets extended by 2 years, right? So in the end, that's 12-year funds. And we are in an illiquid asset class, and I think that you have to be very mindful about it. For us in emerging markets, that's maybe the biggest challenge compared to other markets, right? Because there's not that many exit opportunities, almost no IPOs. So if you can sell, you typically you have to be really hard-nosed to say, I won't sell and I wait for another years, because you don't know if there's going to be another exit. That's changing now. I think in the last few years, there were no exits, not even in the US. So the IPO path was closed. You couldn't sell anything to private equity. It was really, really tough. I think it's getting better now, hopefully. But in emerging markets, I think probably the biggest challenge for our asset class.
Roger, do you want to take the final words on that?
Nothing really thoughtful to add on it. I mean, I guess private markets, they are illiquid, and there are instrument SPVs, AMCs, ETPs, where you can try to semi-liquidate it somehow, that you have less costs to transfer the assets or the investment. But beside that, I mean, that's the definition of private markets, that they are not liquid. Maybe that's one reason why you would expect a little bit more of yield in the long run than if you have liquid markets.
Great final words. Thanks for that, Roger. Should we take 1 or 2 questions from the audience? Who has a question for those subject matter experts here? There's now the chance, or afterwards with a glass of wine.
One to Robert. Robert, before you said the unicorn DNA, what is that?
The unicorn DNA is what we work now on to really select the most probable founders who can create a unicorn. We learned that not each founder is dedicated to commercialize his business, not have the understanding of entrepreneurship, and not each founder will create a unicorn. Some of them will just create, because of their own purpose as a human being, just an SME, because that's enough for them. So we need to understand and judge more on the human being, on their mindset, to understand which are really the unicorn builders and why others not. Not each idea which can become a unicorn will become one. And that's mostly driven by the human and the founder. We work on that.
Just a follow-on question, because I think that touches maybe on operational expertise and excellence in making these companies one day really strong, but in the whole size, I mean, from a startup, but also to private equity assets. So Bertrand, how do you make sure when you choose the investments you go for, that it's not only about finance, but operational excellence that then give you a longevity, let's put it this way, in the asset?
Yeah, so obviously there are lots of parameters which we look at when we invest in a company on behalf of our clients. So the management team is very important. The strategy, what we can do with the company. So should it rather be a buy and build case? Should we cut costs? Should we develop in other markets? There are lots of different possibilities. And then, obviously, then you look at the financials, and then you also look at the extra financial information, the ESG analysis, which is also quite important now. So when we do an investment, obviously, we look at all the different steps in the analysis, and then that's a pretty long process.
Thanks a lot, Bertrand. Having said that, I think we are all thirsty. We're going to close it here. I want to say thank you in the name of Samba to you guys. I mean, for me, it was an honor to actually be on stage with such much competence and key opinion leadership. As you all maybe saw, I wasn't on that investment advisor specialist slide earlier because I'm not an investor specialist at all. So thank you very much for your contribution. Roger, Kai, Bertrand, and Robert, please give the gentlemen a warm applause. Thank you very much.
Yeah, maybe you had the great question, like how do you select a good startup to invest? Maybe Roger, you can maybe share some thoughts, like how you invested in Createch, a very successful company.
it's a tough talk now to have announced the drinks. And then we restart again for another 20 minutes. But no, I mean, what we do at the Studer Family Office, we invest in companies. And then in the early days, for us, it was not that much of an importance that we have a majority so that we can really, let's say, influence what we want to do. And we stopped doing that. Now, if we invest in private debt and in private markets, we want to be in a role where we can influence the company or the private debt for the recovery part. And one company what we have is Createch, which started actually as NSM Engineering. Then we acquired 4 or 5 other companies, integrated them in this Createch company, which we renamed. And Philip is here for 1 or 2 months, 2 minutes to say some words about Createch. How we do this? Huh?
Exactly. It's a pleasure to be here. And this was last session was feeling like home. Maybe quickly to myself. My name is Philip Ringenberg. I'm the CEO of Createch. We are actually executing what you're investing into. So every company that you invest that needs technology, that needs software today, I would not know a startup or a scale-up that can live without it. So this is where we help companies to execute. But as said, I studied in Stanford, and this entrepreneurship and VC, I mean, is like home. As a side job, I'm doing study trips. So if Asia, I couldn't hear it tonight, or if the Silicon Valley is of interest, you let me know. But more importantly, as Roger said, so Roger invested into Createch, and we are executing that support for startups and scale-ups. And what I see there is you always bet on the jockey. So you bet on the team, you bet on the crew to execute. And they start to hire their own bodies, they start to hire their own team, and suddenly their product hits the market. And then, oh my God, how do we execute now? So we have clients, they want our product, and they cannot find those talents. This is exactly where we move in, and we help them to build this tech stack. We help them to accelerate so they can focus on their clients, on their market, and on their growth. And this because we take care of their engineering side, we take care of the software aspect, the foundation of the AI itself. If you ask me an example, you may know Crealogics. I picked that one because most of you may know this company. This is exactly where they were 10 years ago. They started with the digital banking. They served the cantonal banks, and suddenly they all wanted it. And they were not able to deliver. The roadmap was not existent. So they partnered with us, and we support them in really delivering digital banking, digital onboarding, all those components. And we still partner with them today. So we invest into those companies, and we work for long-term partnerships. Now, to wrap it up, I actually would like to summarize what I learned this evening, and probably you can take away the same points. So if we should invest, maybe to the first session, we should invest into the US, we should invest into undervalued companies that are having production in the US, so we know the politics around there. Then we learned that everything in startups happens also on the other side of the Atlantic, so we should definitely look at that in terms of where we put our money. And last but not least, this was not said tonight, but why don't we invest into Switzerland? There is this deep tech nation, Switzerland. I'm not having any shares in there nor stakes, but consider also looking at that, because we can also be proud what we have here in Switzerland, in Zurich. So we have this deep tech nation, so think about looking at that. And with that, I think time for a glass of couple of drinks.
I would like to give the last word to Giovanni, our
Yeah.
So thank you for all being here. I was not supposed to have the last word, but I think if you learn something, it's that investing is a time game. So you need to have time, patience, and there is a new world opening, which is this private asset world for every one of us, which was not accessible actually a few years ago for us. It was only institutional money in there. So I think it was a pleasure to have you here and to add on the view for next year. And I hope, that we're going to be right for the next year performance. Thank you and enjoy the drinks.
Sorry, sorry.
Then you have this. Yeah, you know that you say. I never know when I don't know. In Paris, okay. Also,
Was machen?
Nein, ich baue jetzt hier schnell alles ab, dann sieht das nicht
Ist das
so
mein Kabel oder ist irgendwo?
Das ist alles mein Kabel, alles
Deins,
gut, alles
okay.
gut. Hey, sorry, ist das einmal gecrashed, aber ich glaube, sonst sind wir relativ smooth durch.
Ja, ist gut, danke vielmals.
Ja, gerne.
Ja. Das ist alles dir, oder?
Ja, also ich räume so schnell ab, das sieht ziemlich so aus.
Okay.
Nee, von sonst hier war noch der letzte Plan. Okay, so.